Balancing the exchange. In a 1031 exchange, there is a requirement that you balance the exchange. What we mean by that is that you have to buy for as much as you sold for, but there are rules inherent in that. So first off, buying for as much as you sell for, that comes with a little asterisk. What I mean by that is if you sell for $5 million, the requirement that's quoted most often in a 1031 exchange is that you have to buy for $5 million. The little asterisk to that is that is reduced. The amount that you have to spend is reduced by the allowable costs of the sale as well as the allowable costs on the purchase. So on the sale, you may have things like broker's fees, attorney's fees, transfer tax, items like that. On the purchase, you're probably going to have things like attorney's fees, escrow fees, title insurance fees. That reduces the amount. So if I'm selling for $5 million, I'm actually going to be purchasing for 4 point something because it's going to be reduced by the expenses. To further down the requirement, what you need to do is spend all the net cash. So you sell for a certain amount, you deduct those allowable expenses, and you deduct any debt that you might have, any mortgage debt that you might have, you pay that off, and the net cash is actually what comes to the qualified intermediary. That is the amount that you need to spend on the replacement property. Plus, if you paid off any debt on the relinquished property, the property that you sold, you have to take out an equal or greater amount of financing on the replacement property, the property that you're purchasing. Now, you can take out an equal or greater amount of financing as was paid off on the relinquished property, the sale property, or you can replace it with cash. So in addition to the net cash from the proceeds of the sale, if you had a mortgage that you paid off on the sale, let's say it's $500,000, you have the option of either taking out another $500,000 mortgage or injecting $500,000 from outside the transaction, or a combination. You have to replace that amount in the purchase of the property. You can always buy for more. We're talking about a minimum to have a completely tax-deferred exchange. You can buy for more, you can inject cash into the transaction, or you can leverage up. If you're purchasing multiple replacement properties, so in the example that I just gave, you're selling one and buying one, you can also buy multiple properties. You have to use up all your cash and you have to replace all your debt. And it's important to remember that for balancing the exchange, that doesn't have to be done proportionately among all the properties that you buy. You could load up one property with more debt and then buy another property all cash. And that's balancing the exchange.